Welcome to this next session of life insurance pre-license training. We're going to cover individual life underwriting, pricing, and claims. The purpose of underwriting is risk selection and classification. Each insurance company sets their own standards as to what is an insurable and what's an uninsurable risk. Each application is reviewed to determine if the applicant meets the standards established by the particular insurance company to qualify for its life insurance policies. The first concern of the underwriter is the applicant insurable, and the second concern is if the applicant and insured are two different people, does an insurable interest exist? There are some relationships where insurable interest is considered automatic. For example, a person has an insurable interest in his or her own life. A husband or wife has an insurable interest in their spouse. Parents have insurable interest in their children, and a child has insurable interest in a parent or grandparent. A business has insurable interest in the lives of its officers, directors, and key employees. And business partners have insurable interest in each other. Lenders have insurable interest in their borrowers. All of these exhibit a financial impact if the loss of that life were to happen. An underwriter's job is critical. It is the underwriters who decide which applications to accept or refuse. They can accept risks and charge a higher premium, or they can issue it as preferred. Their goal is to achieve a profitable distribution of exposure, meaning they must select a broad base of risks where the average loss falls within a normal range. Underwriters accomplish this by protecting the insurance company from adverse selection. Adverse selection is the tendency of poorer or higher risk individuals to seek and maintain insurance to a greater extent than the better risk individuals. How do you prevent adverse selection? When an underwriter receives an application and the risk falls out of the normal range, the underwriter has the option to charge a higher premium or place restrictions or exclusions on the policy in order to make the risk fall within the normal range. If that does not work, the underwriter will decline the application. Rating, placing restrictions, or declining a risk is known as adverse underwriting decisions. Underwriters also properly classify risks, differentiating between preferred, standard, and substandard risk classifications. When a client applies for an individual life, health, or disability income insurance, he or she is classified as preferred, standard, or substandard risk. Some companies add another category, ultra preferred or premier. This is based largely on his or her physical condition, lifestyle, and family medical history. Applicants classified as preferred score above average and are eligible for lower premiums. A standard applicant is someone who represents the majority of the people at the same age, in other words, the average person, and they receive normal or standard premium rates. And a substandard risk applicant is below the norm and potentially poses a greater risk that would cost the insurance company more money than a standard risk applicant. This could be due to the proposed insured's health, habits, or occupation. This substantial risk, sometimes called rated applicant, would have higher premiums if accepted. Usually companies offer several options when a policy is rated. They can reduce or limit the amount of coverage. They can add additional premium per $1,000 of death benefit. They can charge for a higher age than the actual age, and they can use a table or tabular rating scheme. If the applicant does not meet any of the underwriting guidelines, the application will be declined. If the applicant paid any premium, they will be offered a full refund. Let's talk about the process of underwriting. Agents, especially life agents, are also known as field underwriters. Field underwriting refers to the agent's personal contact with the applicant. Since the agent represents the insurance company, they must protect the interest of the insurance company. Field underwriting consists of the following. Agents have the duty and responsibility to solicit good business. That means the type of business that falls within the insurance company's underwriting guidelines results in being profitable. So when they target their marketing, they should target the risks that fit inside those company guidelines. At the time of the application is the single most important source of underwriting information. In order for the underwriter to properly evaluate the risk, the agent needs to write clearly or type it clearly on the electronic submission form, make sure it's completely filled out, make sure to probe beyond the stated questions if they suspect there's any misrepresentation or concealment or that the client is not understanding the question. If an answer needs to be corrected, they should follow the insurance company's instructions for correcting that answer. They have to make sure all questions are completely answered on the application and get all the proper signatures. By law, the agent must submit all applications that he has completed. Part of the application is called the agent's report. This is where the agent reports their personal observation about the proposed insured. The agent also provides the purpose of the sale, how long the agent has known the proposed insured, and any information that can assist the underwriter with understanding this person's moral and morale character. This is usually the section of the application where the agent asks if the proposed insured will be replacing any existing life insurance policy with another company. If the answer is yes, then the agent must follow the rules for replacement and get additional forms completed and signed. Let's now talk about underwriting for the risk of HIV and AIDS. An insurance company first must get written consent from an applicant to test for HIV/AIDS. A separate disclosure form is signed by all insureds and agents, and the clients receive a copy. This form includes detailed information about the test and the results of the test. All insurance companies in California today test all applicants for AIDS. If an insured has coverage and dies due to AIDS or ARC, the AIDS-related complex, the insurance company cannot limit or deny coverage. People that were previously insured with you then contract AIDS, get the full benefits of the policies with no discrimination. The test performed for HIV/AIDS must be done and paid for by the insurance company, not the customer. The insurance company must supply the client with information regarding HIV/AIDS from a third-party source. The information gathered must be handled confidentially. The insurance company may decline a potential insured for coverage if his or her medical sample shows positive for HIV/AIDS after 2 different tests have been performed. So it is legal in California to decline a client if they already have AIDS. Insurers in California are to avoid unfair distinctions between individuals of the same class in underwriting life and disability income insurance for the risks of AIDS and HIV. Insurers are required to maintain strict confidentiality of personal information obtained through testing and required to obtain informed consent before testing. Most insurance companies' applications include the consent form to allow the insurance company to test the customer for AIDS. Insurers can test all and pay for the testing. Insurers must provide printed materials describing HIV, its causes, symptoms, and how it spread, and what test is used, as well as suggesting counseling resources. Types of HIV tests are the ELISA test and the reactive Western blot test. Insurance companies can decline based on a positive result from either test. Insurers shall notify the applicant of a positive test result by notifying the applicant and the applicant's designated physician. Sexual orientation may not be used in an insurance company's underwriting criteria, nor may an insurance company try to establish sexual orientation by asking questions about marital status, living arrangements, or beneficiary designations for the sole purpose of determining whether to test for HIV. Insurers who knowingly violate this law shall be penalized with a $1,000 up to $5,000 civil penalty. Let's now talk about genetic testing. Insurance companies are required to obtain informed consent before underwriting on the basis of genetic characteristics. Genetic characteristics means any scientifically or medically identifiable gene or chromosome or alteration thereof, which is known to be a cause of a disease or disorder, or that's determined to be associated with a statistically increased risk of development of a disease or disorder, and that is presently not associated with any symptoms of any disease or disorder. It's a lot. Insurers are required to maintain strict confidentiality of personal information obtained through a test of a person's genetic characteristics. Any insurer that requests an applicant to take a genetic characteristic test shall obtain the applicant's written informed consent for the test. In California, it's legal to use genetic testing along with other testing for existing conditions when you make life insurance decisions. It's illegal to use genetic testing in the decision making for health insurance, however. Let's now talk about underwriting sources. There are various information resources to provide the necessary information to properly underwrite a life insurance risk. They are the application, medical exams and medical history of the prospect, inspection reports, information for the Medical Information Bureau, and the agent's report on the application. Underwriting requirements vary between companies. Every insurer has their own underwriting guidelines, and the requirements will vary from insurance company to insurance company. However, the first and most important source of information is the application. The application contains several parts. Part 1 is the general information section. This part asks for the proposed insured's name, date of birth, address, age, gender, income, marital status, and occupation. In Part 1, it details about the requested coverage, is listed including the type of policy, the amount of insurance, the name and relationship of the beneficiary or beneficiaries, the amount of insurance the proposed insured already owns, any insurance application pending with any other companies, any hazardous hobbies like scuba diving or rock climbing, any foreign travel that's planned, any aviation, meaning private aircraft, not necessarily flying on Southwest, any military service or active military duty, smokers, drug use and alcohol use, traffic tickets or accidents. And then Part 2 of the application asks about the medical information. It asks questions about present and past health, height and weight, current doctor's visits, doctor's name and address, any surgeries, family medical history of mother, fathers, brothers, and sisters, any medications being taken. And then Part 3 is the agent report. We've already discussed this a little bit, but it's very important that the agent take the time to write their observations. It will also have a question that asks if the agent observes any defect or disorder that has not yet been revealed. Let's talk about some of these other sources. The Medical Information Bureau, for example. MIB collects medical and non-medical information. MIB member companies report limited information that is significant to underwriting and application of life, health, and disability income, critical illness, and long-term care insurance. The reports, if any, are brief resumes of one or more of the medical conditions, avocations or hobbies, or test results that are reported by the company in a confidentially coded format. MIB does not receive or collect information from doctors, hospitals, clinics, or other medical or medical-related facilities. All the information the MIB collects comes from the insurance company members. And MIB recorded does not indicate an MIB record. In other words, another company has established a record on your customer. Does not indicate the member company's underwriting decision, the amount of insurance being applied for, or whether a policy was issued and taken. It's only listing the underwriting information that the other company discovered. So if your company is checking the MIB for a customer you're taking an application on, and they see the other company discovered some pre-existing condition like cancer, it's merely a tip-off for the current company to also check for cancer. The new company has to make its own decisions, but this is kind of a red flag that gives them a tip on what to look for. Its purpose is to help disclose information that an applicant forgot or is trying to conceal. It helps with the prevention of misrepresentation and fraud. Another tool that underwriters use is the APS, Attending Physician's Statement. When a proposed insured reveals a condition on the application, the underwriter is more than likely to order an attending physician statement from the proposed insured's own doctor. This request can consist of a few questions or a request for a complete copy of the proposed insured's entire medical file. The cost of these reports is paid by the insurance company. Underwriters also can use credit and inspection reports and Department of Motor Vehicle reports. Independent reports obtained from an independent investigation company or credit agency can be relevant. The inspection checks DMV, court records, mode of living, finances, character, work, and hobbies. Larger cases, they may interview friends, neighbors, or acquaintances. How detailed the report depends on the underwriting guidelines for that company. Poor credit can lead to costly early lapses of the policy. Insurance must be affordable. It helps prevent overinsurance, and credit reports can also indicate whether someone is a moral or a morale risk. They also check for hazardous activities or sports like aviation, scuba diving, auto, boat, or motorcycle racing. Special questions may be required for underwriting to provide more detailed information relating to the proposed insured's occupation, hobbies, foreign residence, or finances. For example, should the proposed insured also be a licensed pilot, the underwriter would need to know how often and what type of aircraft the insured flies. Many companies exclude death by private aircraft when you have a private aviation license. Then there's additional medical testing that can be required. For large cases, large amounts of life insurance, the insurance company may require a complete medical exam rather than just a paramedical exam, which includes an EKG test, a treadmill EKG, and an actual physical exam by a separate doctor other than your own physician. Now let's talk about outcomes of underwriting. The job of the underwriter is to protect the insurance company from acquiring non-profitable business. It's the job of the underwriter to protect the company and at the same time to give the agent an equitable policy which can be sold. By assessing the risk carefully, the underwriter will be able to classify the risk into the appropriate class to determine the rate that should be charged. If both the agent and home office underwriter have done a good job underwriting and following company guidelines, the rates will be fair and adequate, and the insurance company will remain profitable. Let's talk about the rate-making component of the insurance company. Rate-making is the process to determine the pricing. Rate is the cost of a given unit of insurance. Rates are usually expressed per $1,000 of face amount of insurance in life insurance. Premium is the amount paid by the insured. It is the rate multiplied by the number of units of insurance purchased. A policy fee is usually included in the final premiums. In your text, it gives an example of a $100,000 policy where the rate is 50 cents for every $1,000 of coverage, or $50 per $100,000. And then a fee of $5 might be added to that, so the premium for 1 year for $100,000 would be $55. So make sure you take a look at that example. When calculating premium rates, the insurance company assumes the following: that all premiums are paid at the beginning of the year in advance, that all premiums are invested and earn interest for the full year, and all claims are paid at the end of the year. Let's now talk about net premium versus gross premium. Net premium takes into account interest and mortality factors only. It requires the following for calculating this rate: the age and sex of the insured, the benefits to be provided, the mortality rate to be used based on that insured's age, and the rate of interest assumed. So the formula for net premium is mortality minus the interest earned, which equals the net or the pure rate. Gross premium takes into account the interest, mortality, and the company's expenses. The expenses or loading are added into the net premium. So for gross premium, you have the mortality minus the interest earned plus the expense costs added in. That equals the gross premium. That's what companies charge the customer, is the gross premium, so they have enough money to run the company, pay the bills, the light, the heat, the underwriter salaries, etc., and then should have enough money to pay the claims, accounting for some interest that money is earned while it's invested. Let's now talk about the mortality cost. Mortality cost is one of the factors used to calculate an insured's premium. The insurance company uses a mortality table to determine the average number of deaths at the insured's age that will occur during that year. This determines the mortality cost. Cost varies depending on if the insurer is using the CSO 1980 tables or the CSO 2000 tables for their current mortality. As the tables are updated, they're finding obviously people are living longer and longer in the United States. But these tables know literally within 0.1% how many males age 55 are going to die in the United States this year. They know how many 80-year-olds are going to die within 0.1%. What they don't know is who. They know the exact number, but they don't know who in the group of 80-year-olds is going to die. In health and disability, the morbidity table is used to determine the probability of disability at various ages. It also reflects the average duration of the disability. These tables are based on the law of large numbers. Let's now talk about insurer expenses. The expense factors are expenses that the insurance company will incur upon issuing the policy. Included in this is the premium taxes, cost of licenses and fees, policy acquisition costs, administration costs, operations, overhead costs, record keeping, and statistical analysis costs. So all of the overhead of the insurance company and their taxes and fees are included in their expenses. This money is all invested before claims have to be paid. So let's talk about investment return. The insurance company takes the interest earned off the insured's premium that was invested. This interest helps lower the premium for the insured customer. When calculating the insurance premium, the insurance company assumes a low rate of return such as 2 or 3%. Mortality predictions. As mentioned above, insurance companies use a mortality table to calculate when a client is going to die. In the life insurance business, this estimate is the most important thing to consider as premiums are based on this information. Morbidity predicts the likelihood of sickness, and annuity tables predict longevity. All these measures are used in the prediction process to estimate the number of years that someone is going to live. Let's talk about group underwriting. The above information we just discussed applies to individual underwriting of individual life policies. Group underwriting differs from the individual underwriting in that the underwriter considers the group as a whole rather than as individuals. This means that there usually is no medical underwriting or proof of insurability required. This is not always true for smaller groups. It's true for test purposes, however. Group underwriting does not require individual medical exams. Another unique feature is that the policy must cover every eligible employee regardless of health, age, or sex. So the underwriting is done as a group, not on any one individual. Let's now talk about riders on insurance policies. Riders can be used to amend, modify, add, or delete coverage. They are attached to and made part of the contract and considered to be pure protection. A waiver is a type of rider which is used to exclude benefits and for which no premium is charged. Most riders require a premium payment. They increase the total premium, but do not increase the cash value in the contract. Since riders are pure protection, they end when the policy goes into the non-forfeiture phase. And if a policy lapses, the insurance company can refuse to reinstate the policy riders. The two most common riders used in the life insurance industry are accidental death rider and the waiver of premium rider. We're going to discuss more about those later. For the test, you need to be able to identify which of the applicant's needs might be filled by each of the following riders or clauses: a disability income rider, waiver of premium or waiver of monthly deduction rider, accidental death rider, cost of living rider, living needs rider, guaranteed insurability, and long-term care rider. So let's talk about each of those. A disability income rider is exactly like the waiver of premium rider, except with the disability income rider, the insurance company will waive the policy premiums and pay a monthly income to the insured. A waiver of premium or waiver of monthly deduction rider, if the insured becomes totally and permanently disabled, as defined by the policy, the premium for the policy will be waived for the duration of the disability or the duration of the customer's life if they're permanently and totally disabled. The rider becomes inoperative at the age stipulated in the contract, usually age 65. So not all policies will go past age 65. Many of them stop there. The waiting period is usually 6 months and retroactive to the date of disability, providing premiums has been paid and the policy is not lapsed. So give you an example. Let's say you get a stroke or you fall off a ladder at work and break your neck and you're now paralyzed and you can no longer work full time. Most companies will charge you your premium for 6 months, and then if you have this rider, waive the premium up until you're age 65. So the life insurance is basically free for you if you're disabled. And cash and dividends are still paid when the policy is on this waiver. Monthly of waiver deduction is a rider that applies to universal life products where the mortality and expense charge are waived in the event of disability. However, no money goes into the cash account. So the waiver of monthly deduction just waives the cost, but if you were overfunding the universal life policy and putting extra money into the cash account, the waiver doesn't pay that. Another type of disability rider for universal life is called MDB, or monthly disability benefit. This rider will pay the monthly amount that covers the risk charges and the monthly amount that will continue to go into the accumulation account. So it's a little more expensive than the waiver of deduction rider because it's going to pay more money, not only your mortality costs, but the money extra that you were paying into your cash savings account. Let's now talk about accidental death and dismemberment riders. This rider will double or triple the face amount of the life policy should death result within 90 days of an accident, with the accident being the direct result of the death. This rider becomes inoperative at age stipulated in the policy, usually age 65 or 70, and the rider does not build any cash value. The accidental death and dismemberment rider is also known as AD&D and includes a supplemental benefit rider or endorsement providing an amount of money in addition to the basic death benefit of a life insurance policy. This additional amount is payable only if the insured dies, loses any 2 limbs, or the sight of both eyes as a result of an accident. Some AD&D riders pay 1/2 of the benefit amount if the insured loses only 1 limb or the sight in 1 eye. A cost of living rider. This rider increases the term and increases the death benefit in accordance to the Consumer Price Index, the CPI, without proof of insurability. The inflation increase is usually capped at 5%. Increases are usually accompanied by an increase in premium to cover the additional insurance. What always increases is the death benefit, and premiums may or may not increase depending on the insurance company. However, for test purposes, you always should think yes, under cost of living riders, the premium will increase. Let's talk about living needs benefits for terminal illness, critical illness, and chronic illness. Should the insured be diagnosed terminal, the death benefit is advanced to the insured before they die. This can be spent in any way they want. Most insurers do not charge for this rider, and it can be added to both term and permanent policies. It's an advance against the death benefit. That's the terminal illness rider. If you get a letter from a doctor that says you're going to die within 6 months, you can get some of your life insurance before you die. The living need or accelerated benefit rider pays part of the death benefit, usually up to 50% to the insured in the event he's diagnosed with terminal illness that will result within death of 1 to 2 years. The purpose for this rider is to provide money for the insured to pay for medical and nursing care expenses. The rest of the death benefit is paid to the beneficiary at the time the insured dies. Living benefit rider is the name of a rider that some insurance companies add to their permanent policies, usually a universal life policy, as an accelerated death benefit. There are 2 options under which the insured may qualify. The first is the terminal illness option, which is what we just talked about. The insured must be certified by a physician as having a terminal condition that's expected to end in death within a 12-month period. And the owner has the option of requesting prepayments made in a lump sum or equal payments over a 12-month period. And then the nursing home option is the insured must receive care in an eligible nursing home and meet a 6-month nursing home confinement elimination period before the benefits can begin. Usually payouts will be in the form of a certain period annuity. So if you're confined to a nursing home and you have that option on your life insurance policy, after 6 months, you can take some of your existing life benefit and cash it out and use it to pay for the nursing home care. Chronic illness rider is a third one, is another form of accelerated death benefit. If the insured is certified by a licensed healthcare practitioner within the past 12 months as chronically ill, defined as either unable to perform at least 2 of the activities of daily living without assistance for at least 90 days, or requiring substantial supervision for protection from health and safety threats due to severe cognitive impairment, the insured is eligible to receive benefits off their life policy. This rider resembles long-term care riders that we discussed in a minute. So if you are so sick you can't get out of bed by yourself and can't go to the bathroom by yourself and need somebody to come into your house and help you, and then once you're dressed you're fine all day, and then at night somebody needs to come in and help you get ready for bed, those are activities of daily living. If you need help with 2 of those 6, which is ambulating, walking, transferring, getting up, transferring your weight, or toileting, showering, or preparing food, then you can use part of your life insurance while you're still alive to pay for those expenses. The next part of the living needs program is the critical illness accelerated benefit rider, which pays a lump sum benefit to the policy owner upon the insured's first diagnosis of a covered condition. Covered conditions, subject to the terms of the rider, usually include heart attack, life-threatening cancer, stroke, end-stage kidney failure, major organ transplant, permanent paralysis, and the loss of limb. There are no restrictions on how the benefits can be used. So if you have this rider and you have a heart attack, and there's, say, a $50,000 critical illness accelerated benefit rider on your policy, and you have a heart attack, you didn't die, you're fully recovered, you're back to work, they'll pay you the $50,000. off of this rider because you had a heart attack. Same thing applies if you get a stroke or kidney failure or major organ transplant. So this is a very popular rider in the life insurance industry today. Let's now talk about the guaranteed insurability rider. This rider allows the insured to purchase additional amounts of insurance at specified ages or dates without proof of insurability by paying an additional premium on the current policy for the rider. Whether the policy is set up to make offers at specified ages or dates, both ways offer additional offers for special events. These special events could be a marriage or the birth of a child. If the insured notifies the insurance company within 90 days of this event, they will be granted an additional offer of life insurance, again without proof of insurability. The rider ceases when the insured is in their 40s. The offer is typically every 3 years from age 25 up to age 40 if it's based on the year option. Premiums for the new policies are based upon the attained age. The next rider we want to talk about is a long-term care rider. A long-term care rider allows the insured to tap into their life insurance policy's death benefit to pay for qualifying nursing home care or home health care expenses. Any amount used for the approved long-term care expenses will reduce the policy's death benefit. When the insured adds this rider to a life insurance policy, their benefit is normally paid either by long-term care payments or as a legacy for their loved ones. A long-term care rider provides monthly benefits for nursing home care or home health care of the person whose life is covered on the policy. The benefit is paid whenever qualifying conditions and the 90-day waiting period, known as an elimination period, are met. Benefit payments under this rider reduce the policy's death benefit. This rider is offered to insureds at an additional cost. Let's talk about licensing for this rider. Long-term care license training is required in order to sell this coverage. Since this rider differs from the chronic illness rider in the fact that this rider is used to pay long-term care expenses, this requires those agents who sell it to be subject to the continuing education requirement hours required for long-term care insurance, as well as that the agent be licensed in accident and health insurance. So the chronic illness rider is really not long-term care. You trigger the payment under chronic illness by having difficulty with the activities of daily living, but you can use the money however you want. For this long-term care rider, you can only use the money to pay long-term care expenses. And because of that, it requires the long-term care continuing education training in order to have the Department of Insurance certify you to be able to sell this rider. The chronic illness rider does not require that. Let's now talk about the no-lapse guarantee riders. This rider applies to universal life policies. Universal life is a flexible premium policy, and there's no required payment schedule. It's easy to lose track of how much money is required to keep this policy in force, and the insured risks lapsing the policy. So this rider imposes a payment schedule upon the basic universal life policy so that certain payments are required, and those payments will prevent the policy from lapsing. In effect, it turns the universal life policy into a whole life policy, but with no endowment. Then a rider called the family rider covers the spouse and children, can be sold in units. For example, one unit equals $2,500, or in some companies, one unit is $1,000. If the insured purchased 4 units for the children's riders, when the per unit value is $2,500, they would then have $10,000 of coverage for life on the wife and the children. Let's now talk about annuity riders. There's guaranteed living benefit riders is one of the reasons why all of the recent activity in annuity sales nationwide. Most annuity providers have been rolling out guaranteed living benefit riders one after another for the last 8 or 10 years. Let's talk about each one of them. There's a guaranteed minimum income benefit rider. It guarantees that when a contract is annuitized, the income payments will be based on the greater of the actual contract value or a minimum payout base. And this base typically equals the amounts invested credited with a competitive interest rate of, say, 5%. The next rider is the guaranteed minimum withdrawal benefit rider. It guarantees that investors can withdraw a guaranteed fixed percentage, usually 5 to 7% of the annuity premiums, for a specified period until the entire amount of paid premiums has been withdrawn, regardless of market performance in the underlying fund. Then there's guaranteed minimum accumulation benefit rider. It guarantees that the variable annuity contract value will be at least equal to the certain minimum amount, usually the premium paid, after a certain number of years, regardless of actual account performance. Then the guaranteed payout annuity floor. It guarantees that the annuity owner's monthly income payment will never be less than a certain percentage, from 80 to 100% of the first payment. Then the guaranteed lifetime income rider guarantees that the annuity owner will receive an annual payment, a guaranteed withdrawal payment, for life, even if there's a drop in the policy's accumulation value. And then the guaranteed account value rider guarantees the annuity owner principal over the course of a specific investment period and may automatically lock in any gains at the end of each quarter or at the end of each year. So they're giving you a guaranteed value. Then there's a guaranteed minimum income benefit. It guarantees that the owner may annuitize the contract based on the greater of the actual account value or a payout base equal to premium credited with some interest rate or the maximum anniversary value of the account during the years. Then there's a guaranteed minimum death benefit rider. It guarantees a basic death benefit equal to the greater of the contract value or the premium payments less any withdrawals and is made to the beneficiary upon the death of the owner. And then there's a long-term care rider. If the annuitant becomes confined to a nursing home or is unable to take care of themselves, this rider allows them to access more of the annuity's accumulation value, possibly up to 100%, without the surrender charges or distribution costs that would be otherwise applicable, and they can use the money towards their long-term care costs. Let's now talk about some financial reports for life insurance. The state of California requires every insurance company to submit a financial report by March 1st of every year, showing the company's financial condition as of December 31st on the previous year. This report must include the following information: the financial condition of the company's operating results, any change in the financial condition, capital or surplus, the capital and capital stock and assets, liabilities, income and expenses, a balance sheet of premium notes, accounts, and all businesses, the total amount of new business gained during the year in California, and total premiums received on business written in California. With this information, the insurance company or the insurance department analyzes the financial strength of every company, and outside agencies also have access to this information and rate and score or grade the financial strength of every company in the insurance industry. Potential customers should research an insurance company's financial strength rating. Certain independent companies make insurance ratings simple by grading the financial strength of these companies. This is through an insurance rating system similar to school grades. Insurance rating analysis are independent companies paid to evaluate an insurance company's financial strength. Below, we're going to find a chart with some of the financial ratings from 4 of the leading companies. AM Best, Standard & Poor's, Moody's, and Fitch regularly analyze life insurance companies and give them grades. For example, the top grade at AM Best is A++. The top grade at Standard & Poor's is AAA, 3 capital A's. The top grade at Moody's is capital A and 2 small a's, big A, small a, and Fitch uses also the AAA rating for their highest. They'll go down to 10 or 11 or 12 ratings and scores for each company. They're all a little bit different, and you should study that chart so you're familiar with the kinds of ratings. Most governments and people consider any company graded below a B plus for AM Best, or a A for Standard & Poor's, or a B1, B2, B3 for Moody's, or a single A for Fitch as weak. B plus, A plus, or higher are considered strong, very secure, but B's and low A's are on the weaker end of the scale. And of course, they go all the way down to C's, where they're very, very weak. So financial ratings are important to make sure that the insurance company you're investing your money is strong and will be around to pay their claims. That concludes this section. It's now time to take your test tips.